Talk about interest rate buy down. Mm-hmm. So, interest rates are at 6% and I want to buy down the rate. I want to buy a home. I want to buy down the rate.
In combination with that, so buy down points. Mm-hmm. Someone says, I want to buy down my rate. And what does that mean? And if I want to lower my interest rate by a point, can you clarify that? What that means?
Point.
Listen.
And how do I do that?
It's all relative to that day. So the cost for a rate varies every day based on the pricing of that day. They change every day. So when someone says, I want to buy my rate down, how much money do you have? It goes back to what do you want to spend? And I can tell you what that will buy, what that will get you.
Welcome back, you guys, to Key and Will's The More You Know podcast. Thank you for joining today. Today, we're going to be talking about mortgages. Everything
was that your Oprah?
You get a mortgage. You get a mortgage. You get a mortgage. So today is our special guest, you guys. We have someone in the building who knows more than you could possibly imagine. Welcome back to our podcast, Micole
Sudduth. You got to get it. We know you got to give it to the audience.
I know.
You got to do the whole thing.
I almost want to say welcome back, Sassy.
I know
it's so hard for me to say Micole. That is
she very rarely calls me that. She never calls me that.
But we have Micole Sudduth in the building, you guys, and she knows everything there is to know about mortgages.
Listen, family, if you go back on several episodes, this might have been a year since we've talked to Micole. But Micole is one of our preferred lenders. She's amazing. She's amazing. She's been in the game. How long, Micole?
Over 25. Let's just leave it there.
Over 25. So right out of high school, she came straight into the mortgage industry. But Micole is amazing. She is a great friend of ours. But we wanted to talk about mortgages because now, really this past year, interest rates have been sort of going up. And now they're starting to stabilize a little bit. So we wanted to talk to Micole and talk to the expert who does this on a day-to-day basis to really talk about how interest rates work and how does that influence when the feds cut the rate. Does that automatically mean mortgage rates go down? How is unemployment impacting interest rates? Like the whole nine. So we want to really just have a discussion and she can give us some tips and tricks on, what's needed when you really want to purchase a home, right? Yeah. So we got some folks out there they're looking for 2025.
Interest rates.
They're ready to buy investments in real estate.
Yeah.
So welcome, Micole.
Welcome back. Welcome back. Thank you for being here.
Can we do a cheers?
Oh, yeah.
Let's do a toast.
This is what we do on the podcast. It's all laid back. This is what we do.
Take a sip.
So Micole, mortgage rates. Listen, being that you've been in the industry so long, you've worked with so many realtors over the years, and we rely on you to really give us your expert opinion in helping our clients really get to the closing table. Mm-hmm. So before we get into the interest rates and all that stuff, for those out there who've really been waiting to purchase a property and they may not know exactly what is needed, even to start, like, what do I need to do? How much money do I need? When you get a new client, what is that discussion like for someone who has no idea where to start?
That's interesting. I mean, I always do a consultation with my clients. And the main thing is to determine where you are in this process, because everybody has a specific situation. Right. And so to say, okay, well, you need no money down or you need 20% down, you can't just give that blanket statement because it really depends on your situation.
Yeah.
So I normally, after they complete the application, I look at the credit, I look at the income, I look at how long they've been on their job, what kind of job they have. Is it hourly? Is it salary?
Wow.
Is
so
it
all
variable?
That matters.
It's so many parts. That's why when you hear people talk about what's needed for a mortgage, you really can't say that without knowing the individual.
Right.
So I look at that and then we have a conversation, and I don't qualify people based on what my max amount could be for debt to income ratio for guideline purposes. Gotcha. I talk to you about okay, tell me what you're paying in rent. Even if I see an application, where do you want to keep your mortgage payment? Gotcha. Okay, you tell me I want to spend $2,000. Okay, well, this is the sales price associated with $2,000. Oh, I can't find anything for that. Mm-hmm. Well,
it is an eye opener.
It is an eye opener.
Yeah.
So we normally end up in a place that's comfortable for, of course, qualifying ranges, but also their lifestyle. Where do you want to live?
Yeah.
That the down payment assistance, if you get that, if you qualify for that, can depend on the location of the property. Okay. So it's a lot of different things.
A lot of things go into
And that's why you have that consultation up front, because even our clients that come to us, it's great to break it down. We get on Zoom, we just talk and say, what are you trying to do? What's your plans? Have you thought about this? And we give sort of just a range of options. So they're educated and making that decision moving forward.
Right. When someone comes to you and they say, or they'll come to their realtor and they say, well, I spend $1,500 in rent. That's what I want to spend for a mortgage. What do you say?
I break down what, like I said, what $1,500, because I don't want to be condescending or discouraging.
Sure.
Right. But
you have to be realistic.
I want to give you the reality of that, because a lot of people don't realize that the market has changed so much from when you used to be able to say $1,500 and that could buy you a much bigger home than it can now. So it's just readjusting, the reality of where we are.
And that's what we say. We let our clients know, listen, because when I bought my house years ago, my first house years ago, I was thinking of that home as a forever home. Mm-hmm. I wasn't thinking of it like, oh, this is my first investment. This is my starter home. Right. In 4 to 5 years, I get my next home. Mm-hmm. I was thinking, this is where I'm going to live forever. That tells you how much this was in 98. So this was way back. But I wasn't educated at the time. My realtor didn't really give me sort of the ins and out of, hey, maybe you want to keep this property. Maybe you want to rent it. Maybe. So we didn't have those options. But we try to sit with our clients and say, hey, this first property may not be your forever home.
Absolutely.
You want the big home with the huge backyard and the lake in the back. But I say you can get that. But it may just be, maybe that'll be the next home.
Right.
But I tell folks, do not wait for your forever home. Get your property now. We just was talking to a client today. They've been in their home a few years now. They've accumulated $100,000 in equity because of where they're located. Yeah. $100,000 in equity. So now they have the option. Okay, this wasn't my forever home, but now I have $100,000. If I sell my home, I have enough money to put down on my next home, which will be that forever home.
Yeah.
So never think that you have to get that forever home just right away.
No, that's what home ownership is as we also say, generational wealth, or just wealth building in general. So that you can take that to the next property and that equity to the next property and next property. And then, you do get that. But spending money on rent, that's a brick wall. Yeah. Period.
It's a brick wall. But a lot of individuals think that, well, I'd rather rent, right? And renting is not bad. So let's get that clear. It's not bad. However, in the long term, you're paying someone else's mortgage.
Exactly.
Right?
Yeah.
But they say, well, I don't want the responsibilities. I don't have to take care of the yard. I want to have to, if there's a roof leak, I don't want to have to take care of this, take care of that. And I understand that. However, we've seen time and time again when we've talked to our clients and really explained the benefits. And once they've gotten in that home and they've gotten ready to sell, they say, listen, y'all, I'm so glad y'all pushed me.
Right.
I'm so glad we got a guy downtown in a high rise. He's a Falcon fan. He say, Willie, whatever you do, I need to be downtown in walking distance to get to the games. And it was tough. He probably watching this. It was tough. We went through a lot, and we finally got him in that. And now today he's like, man, thank y'all so much. And now he looks at what it's worth. Now
that's
he's
an investment.
At that time, I thought I was like barely, but now it's an investment for his next property.
Exactly.
Yeah.
Exactly.
So Micole, $100,000 in equity, you're able to sell your home. I feel like, and you tell me if this is right or wrong, that $100,000 still doesn't get you what it used to get you because of the interest rate. Can we talk a little bit about how the interest rate impacts what you're able to do? Because I have $100,000, but if my interest rate is 6.5%, versus when we were, 2020 during COVID, we could get 2%.
Ooh, if I can go back to 2020,
then
I got about 6-7 homes.
that's a little bit of a different ballgame now,
definitely.
right? So talk a little bit about interest rate and how that impacts what you're able to do.
I mean, definitely, it does minimize what you can purchase based on, the difference in the rate between, of course, where we were and where we are. $100,000 right now. So, for instance, if we were just saying interest rates right now, they are kind of all over the place, y'all, just for the record. I mean, we got this election coming up. So I don't think the economy, the feds, they just don't really know what direction to go in right now. So, we had the cut and then, mortgage companies kind of cut a little too low. In anticipation of it. That's what they do when they know that they're going to cut them, and then they had to raise them to balance it back out.
They went back up. I was like, hold on.
Yeah. And they're still moving. So, $100,000 at a 6.5% rate, maybe 700 versus that 2.5% rate, it was like 3.
Right.
So it is a huge
big difference.
And that's I'm just saying principal and interest part of it. So it is a big difference between what you can purchase. But it just means you just have to readjust some things. It's not take yourself out the game totally.
Right.
Just, and so for some people, it's just also readjusting some other budgeting or some other priorities, I should say.
Got you. Talk about how this works when they say, the feds are meeting tomorrow. Let's wait and see, because we've had a situation, things from a listing or a seller's perspective is also impacted when the interest rates are high. Yeah. Meaning if the interest rates are high, there's not a lot of people out there buying. They're like, we're going to wait until the interest rates drop. And so we've had some of our sellers, hoping, the feds are meeting. We're really hoping that means they're going to drop the interest rates. But is that a direct correlation?
That's what I'm saying. It's not a direct correlation, unfortunately. And it's not, even when they give you a certain percentage point, like a half a point or whatever they did this last time. And people thought that literally meant a half a point in whatever rates. But a lot of it is in pricing as well. And pricing is the cost for the rate. It doesn't necessarily mean
the actual interest rate is dropping. Meaning it's not, they met, and so we're going to go from 6% to 5.5%.
Yeah. It may be that it costs a point to get 6%. Now it may cost half a point to get 6% versus the extra rate.
Gotcha. Okay.
And that's a huge misunderstanding.
That is a huge misunderstanding.
Wow.
Yeah.
So the economy, definitely has an impact on the feds. The economy, how's the economy doing, and inflation and unemployment, all that stuff helps. But it seems as though interest rates, like you said, it's
the opposite. When we seem like we're spending more money, then the rates are higher. When we spend less money, the rates are lower.
Wow. That's crazy. So listen, we always say in regards to real estate, I don't think they're making any more land.
We don't have to think. They're not. This is what it is.
God did what he was going to do. So listen, we always say purchase land if you can afford it.
If you can afford
clients ask me, is it a good time to purchase? We always say it's really depending on you, your financial situation. Can you afford it? Can you, can you make the payments? Can you do them? So because we found that really when it comes to generational wealth, and that's why we're so excited and we get so amped up, with our clients, because we see the benefits over the years that, we have another client where it's like, I'm buying this home is going to be, they have about 4 properties now. This one is going to be for my daughter.
Yeah.
My son, this one will be for my son.
Yeah.
And it's just like, it just blows my mind how they're thinking generationally.
Yes.
And how once they get to a certain age, they already own.
Yeah.
And that's huge.
It is.
That's huge.
It is. That's a wonderful
great
thing.
Yeah. Do you feel like this is the rates are actually going to drop? You know, for people out there who are interested in understanding, all right, we know when the feds meet, that's not a direct correlation.
Right.
But at the end of the day, the question is, when will rates be at a place where it's affordable for us to buy? Because at 7%, I can afford less of a home than if it's 5%, I can afford that home that was at 7%. I couldn't afford it at 7%, but at 5%, maybe I can.
Right.
Is there going to be a point this year where we're like, oh, yes. Oh, okay. Interest rates are lower and it's going to be a boom in the housing market?
I mean, I don't know, but I don't think so, unfortunately. Okay. I mean, I didn't want you to make me have to say that. But
Right.
probably not. I think.
Are we going to be stable?
I think we're trying to stabilize.
We're trying to predict that,
I think we're stabilizing it. And we're still lower than we were whenever we were at our highest. We're not in the sevens. We're not in the sevens. Which is great. You know, we're in the sixes realistically, which is not bad.
But I mean, realistically, this is normal.
It is.
Right?
It really is. We just got so spoiled.
We got so spoiled during COVID.
At 2%.
Oh my God. That was, were rates really at 2% during COVID? 1.5, 1.7?
I don't know any ones. I don't know any ones.
Okay.
But I know they were 2. I have a 2.75 on my primary.
Yeah.
Okay, you bragging now, Micole.
I'm not bragging.
No,
I'm not.
But that's what it was.
That's what it was.
2.75.
I mean, I refinanced, of course.
We did too.
We refinanced. And that's another thing.
Yeah, and that's the thing. You can refi.
You can I won't say you can always refi, but you should have the option to refi, family. So even if you come in now, it's like, okay, it may be 6.5% now, but maybe in 2-3 years you say, you know what, let me refi.
If the interest rate is such that it makes sense.
If it makes sense.
Right.
Yeah.
Right.
Talk about interest rate buy down. So, interest rates are at 6% and I want to buy down the rate. I want to buy a home. I want to buy down the rate.
In combination with that, so buy down points. Someone says, oh, I want to buy down my rate. And what does that mean? And if I want to lower my interest rate by a point, can you clarify that? What
1
that
percentage
means?
point.
Listen.
And how do I do that?
It's all relative to that day. Like it's not a cut and it's not cut and dry. So the cost for a rate varies every day based on the pricing of that day. So, if you say I want to buy a 6% rate down to 5.5, it will take you, oh my God, a lot of money to buy a rate down that low.
Just 0.5%.
Just
and
0.5%.
it may or may not be worth it.
It may or may not believe. I know today I remember I was looking at it for a young a gentleman. 5.625 was costing, and this was on he had a $280,000 sales price.
Okay.
So 5.625 was costing $8,500. And the difference between that, because rates have kind of moved since we first started looking, we were originally looking at 5.5, it was like $11,000.
Wow.
Really?
Wow.
So it really
I'm keep my money.
And this young man had like a 736 credit score.
Great.
So it's not like
great credit.
I'm sorry, 786 credit score. Not even
excellent credit.
He had excellent credit. So I say all that to say, and that was just based on the rates today. They change every day. So when someone says, I want to buy my rate down, how much money do you have? It goes back to what do you want to spend? And I can tell you what that will buy, that will get you.
And I like the fact that you do that. You actually talk to your clients and educate them, say, this is what it means. You may or may not want to buy that rate down because in the long run, this is how much it'll be.
Exactly.
That's what you'll save over time.
Right.
So, I'm glad you talked.
Yeah, it makes sense. So you have to analyze. That's a good point, Willie. how much are you saving per month with the difference in the rate, and how much will it take you for that dollar amount to buy it down over time? So you calculate.
Right.
So is it going to take you 10 years to break even, and you know you're going to be, you want to be there 5, then don't do it.
Right.
And that's another thing going back to when I purchased my first home in 98, having that discussion of how long are you planning on staying here?
Mm-hmm.
I didn't even think that. Like, I bought me a home, but now that obviously we're realtors and we're educated on the process, but we try to educate our clients like, yo, how long are you planning on staying here? 5 years, 3 years, 10 years.
Right.
And depending on what the answer is, you really can strategically plan a different route.
Yeah, absolutely. Yeah,
Wow.
makes a difference.
We were talking about generational wealth earlier. We have clients, a few that have come together to purchase a property.
I love that.
Families.
And that is
multiple family homes.
And that is something that I think is just so amazing. We had a client, might have been a few years ago, that when they first did it, wasn't really popular. I was like, you gonna do what? So we had you want to, Key, I hear you jumping in. You want to?
Yeah, no, I mean, basically, mother, father had a home. Their daughter and her husband and baby had a home. And then their other daughter had a home. And they all three sold their homes and moved in together. They purchased a home that was large enough that they could live without infringing on each other's privacy.
The bottom floor, and then when they bought it, they
put their money together, their proceeds from the sale. Are you seeing that a lot more? Are you seeing that trend more?
Not in the Black community, unfortunately.
I think it's something that
I love the concept.
We should always think about, because the way and you go there now, they've done amazing work.
I'm gonna sell my mama house and move and take that money and move her in. That's what I'm really about to do.
We can do that with friends too. It doesn't have, we are family.
That's true.
But I think at least I can speak for myself. Yeah. Growing up, I was like, I want my own place. I want my own. But when you think about it from a equity standpoint, it just makes so much sense, even if it's short term.
Yeah.
Because the client that we're talking about, the first level, it has its own kitchen, living room.
Yeah, it's large enough that they can accommodate and have privacy.
Yeah.
And the grandchild
as adults
is in the home with their grandparents.
Exactly.
So now
living
you have that benefit too.
Yeah.
But that child can now have more time with their grandparents and all.
But I also think that they what they did do is they did it in a very smart and strategic way, meaning they put together a contract that said, if you decide to leave, this is what you need to do to buy us out. You're not just going to leave and leave us hanging with this huge mortgage, because to buy that size of a home to accommodate a family, for everyone to have their own privacy, that's a really large home.
It is, yeah.
So, that you just have to be thoughtful in that regard. But, I think it's a smart concept.
I do too.
I
love the concept.
I think our family out there should consider it, even if it's short term, like Micole said, even if you get with a friend and say, hey, let's buy this property together. Let's split this mortgage. And then in a couple years, we split the proceeds.
Exactly.
And then we can each buy our own home.
And sometimes our community, we'll be so quick to say, well, you turn 18, you got to get out.
Right.
It's time for you to move on. And I understand that, but go out, figure out what it is you're going to do. But it's okay to come back. If you want to come back, that's not a bad thing. Let's figure out how this works for us as a family.
Exactly.
So, I don't know. Let's talk, Micole, about affordable housing. What does that mean? What you hear that term quite a bit?
We do,
and help the audience understand what affordable housing means.
Hey, let me know. I mean, in this market, I think it's all relative. I think that
is that a program? Is that why does that term keep popping up? You'll see it on social media and people kind of promoting that, but I think that, is that something that when you go to your lender, you ask for like, what does that mean?
I mean, there is no necessarily affordable mortgage or loan that
or
has
program.
Not specifically for any that has any specific terms. Let me say that. Like I said, it's all relative to what's affordable to you.
Okay.
And I think that's why people use it, because it can be used so broadly, loosely, broadly. Like, I know, like, they're talking about tearing down certain housing projects or the hospital or so we're going to put affordable housing. And I always say, really?
What is that?
What is that? Yeah. And especially in Atlanta, like, what is that?
It's affordable housing to me, because if you were to look for a home that costs $250,000, you're going to get tear downs, basically, at this point. It is very difficult to find anything for $250,000 or less.
If you're out in the suburbs and you're
not
out
in the
there,
city, it's hard in the city.
But in the city, it's tough.
Even beyond, I mean, I feel like at this point, you used to be able to say, if you go south, you can find homes. But even at this point, I feel like that's very difficult to find anymore. So affordable housing to me means if you're going to build homes starting at the $250,000 mark, that's affordable.
Yeah.
Right. But I don't know if anyone is building homes at that price point anymore.
No, because, the people who are building the homes, they're trying to make money.
They're trying to make money.
So the cost for lumber is up. The cost for everything is up. So the profit level, when you build at a certain price point, the profit level is minimized. Right. And, unfortunately, most builders are not here, they're not nonprofit. They're trying to
make a profit.
So that's why I say affordability is all relative to the buyer, to the market. I mean, the market meaning what the area. I mean, I think, honestly, we've just gotten so far away from that term, the way I look at it in Atlanta. I really don't feel like we have much affordable housing based on the buyers that I deal with and what they need to be able to purchase. I think we've gotten
the thing
so far away from it.
People don't, because we can't see into the future. Because even during COVID times, we literally was telling folks, buy property, like we're doing now. Yeah. Buy property. This is the benefits. This is all this. Now, it's like none of us have a crystal ball. We can see into the future. But I think when we rely on experts like yourself, like us as realtors, that you trust, right? It's like, but you just never know, because real estate, over time, it's a long game. I tell all of our mentees, it's a long game. And I think over time, you'll get that money back.
You will. And like I said, it may not be your dream home, but at least you can. There are some options for you to purchase something but it will be yours versus it being, versus you continuing to rent. Yeah,
exactly. So. Yeah. Can you talk about the difference between FHA and conventional? I think that's one of the things we spoke about when the last time. But we had a client who came to us and said, our lender is, I can't remember the kind of what they said, but we're going to do FHA. I was like, well, how do you know? Like, is that something you ask for, or so that everyone out there understands the difference between FHA and conventional? To me, I feel like if a client comes to a lender, they're going to say, I'm ready to buy a home. You don't go to them and ask for specific packages, right? Or you may say, I'm a first-time home buyer. But for you to say, FHA, I want... So talk a little bit about what that means.
No, I think Micole was about to say this. That's what the experts are for. They let you know which product works
best for your situation.
That's correct. And it depends on your credit. It depends on your income. It depends on your debt to income. There's so many things. FHA is a lot more lenient. Let's say that.
Okay.
So the debt to income ratio limits are much higher. For instance, just to put it in relative terms, we can go up to a 57% as long as the automated underwriting system, because all lenders run their loans through automated underwriting systems. Okay. As long as it accepts it, you can go up to a 57.5 57.4, because 57.5 you round up, that's 58.
Okay, right.
Okay, so 57.4.
What does that 57.4 mean?
That's your back end ratio. So
Okay,
that means
that's your back-end
all of
ratio,
your
guys.
monthly debts that you have, car note,
Mm-hmm.
credit cards or whatever, plus your estimated monthly mortgage payment cannot be more than 57% of your monthly gross income.
Ooh,
Okay,
Income
guys.
before taxes.
Oh, that was
Yeah, it's a lot.
So make sure you
that
caught
was very
that.
clear. I like how you
Yeah.
explained that. So that DTI, that debt to income ratio,
DTI means debt to income ratio.
Yes, it
is
is.
important.
Debt to income. It is. And that's how I determine whether or not I'm going to use an FHA loan or a conventional loan, depending on where you're trying to buy and what your debt to income ratio is and your credit score. It's almost like, as a lender, you can almost look at a profile and say, this is direction you need to go in to get the best opportunity for you. I'm not trying to pigeonhole you.
Right.
It's about what's going to give you the best option for you.
For your specific situation.
Correct.
Right.
So conventional, if you have a buyer who's wanting to put less down or has a high credit score and low debt to income ratio, yeah, we could do conventional. I mean, to be honest, the FHA rate is lower.
Okay.
Nobody knows that. The FHA rate is lower.
They know now, Micole.
They know now. The FHA rate is lower, but it's that mortgage insurance that has been hanging around forever that everybody talks about when it comes to conventional financing, which FHA has reduced that minimum mortgage insurance rate so low. It's competitive to conventional now. It's not even.
Oh, okay.
Sometimes
That's
it's
good to know.
lower. Sometimes it's lower than conventional. So if you get out of your way, or that your mother and your grandmother's thinking, oh, that MI, I get it all the time. That MI, you don't even know what it is.
Yeah.
You just say, I don't want that MI. You're like, okay, well, let me show you what that
really means.
Yeah.
So at what point can you get rid of that MI, that mortgage insurance?
On conventional, after you've been in the home a minimum of 2 years and you have at least 20% of equity in the property.
Okay. So even if I just purchased the home.
That's good info.
And a year from now, all of a sudden my equity shot up because now my house was worth $250. Now it's worth $350.
Mm-hmm.
So
not a year, 2 years.
2 years.
Nobody talks about that.
2 years. Okay. That's why I want to know.
Let's be clear.
So 2 years.
Minimum of 2 years.
Minimum of 2 years. Gotcha.
FHA, it is 11 years.
Okay. So that's
once you have a 20% or more equity.
That's a difference.
That's a difference.
So you have that mortgage insurance for 11 years, even though, gotcha. So that's what you have to weigh as a consumer. Mm-hmm. It's like, should I do conventional? Should I do FHA?
If you can weigh. Sometimes it's not an option for you. You know what I mean? Like
that's right.
Sometimes it's just not an option.
It's not an option. Sometimes FHA is what you get.
It's what that's on, right. Yeah. That's your only way to
your
finance.
Specifications. Yeah.
I don't know if this is a misnomer or, but is FHA more restrictive? Meaning, I can't do a condo, or sometimes you'll look at listings that say FHA not accepted or something to that effect. Mm-hmm. So help us understand why there may be some restrictions around FHA.
So condos are different. They're just different in general. Like they have all these rules, regardless of whether it's conventional FHA, you can't have so many rentals. You can't have so many delinquencies. You can't have your insurance on the property be over a certain deductible. They got all kind of rules
for condos.
So, you just add the FHA part to it. You have to have a specific FHA approval but you can do what we call a spot approval, where the lender can send it in and get that done. Mm-hmm. It's just if the listing agent is willing to let the lender take the time to do it, which is not really. So that's the condo. We'll put them to the side. Okay. Yeah. So
what about for fixer-uppers? If it's an older home, I'm FHA, and there's some things that need to be repaired in the home. Does that affect me being FHA approved?
FHA has removed so many of those cosmetic restrictions. They're almost equal with conventional on that.
Okay. Oh, that's good to know.
Yeah. The only other thing that I was going to say is what we call flips. So if the seller has acquired the property in less than 91 days, you can't do an FHA loan.
Okay.
So you can't do a quick close on it, like an investor purchased it. So sometimes when you see your listings, that you'll see it for that reason. Like they just bought it and they know they can't do an FHA loan.
Okay.
Speaking of investors, a lot of investors use what we call hard money loans, right?
Mm-hmm.
And as opposed
Loan
to
sharks.
I'm
just kidding.
I love it, Micole. They use loan sharks.
They are loan sharks. They are.
So there's hard money loans and there's loan sharks. And then there's your conventional, the major companies that you've been working for over the past couple of decades.
Yeah. Your traditional.
So what are your thoughts? Again, for those who are looking to invest, should I use a hard money lender? And that's basically, a smaller outfit where that money is due sooner. Than
with
later.
a higher interest rate.
Higher interest rates. There's risk involved. What are your thoughts on hard money loans?
I mean, I'm not a fan. But if you do it, it has to be something that you know is going to be a quick flip and that you're going to be able to resell it. You have to know that. Like, you can't guess. Like, you have to know. That's the only way that will work. And it's not, it wouldn't be buying it as an investment to keep it to rent. You would only do that if you need to really do some renovations or flip it.
And flip it. Yeah. I think in my opinion, hard money loans are for investors who are very savvy in investments and they know they're able to do kind of the numbers to determine, if that hard money loan makes sense for them.
Yeah.
So I don't think there's, I think there's probably some bad sides to hard money loans if you're not savvy enough to do that. Savvy. But if you're an investor and you're accustomed to doing that, hey, it is what it is. I think it's okay.
True investors who've been doing it a while, they know.
Yeah, and they have somebody that they've probably been dealing with who does hard money loans for them. Hey, we're back again. We're going to do this again. We're about to do this flip. And they're in it together. It works perfectly for them.
This is my after repair value. This is what it's going to be. I should be able to sell it in 60 days. So I think it's a great short-term option.
Yeah.
For experienced people.
For experienced people.
Investors. But as Micole say, you got to really understand.
You got to know.
And know what you're working with.
And they come around, they say, this money is due.
This money due.
Tomorrow. You're
like, wait,
what?
I need my money.
Wait, what?
Yeah.
So Micole, what's the biggest thing that can impact getting a mortgage? Meaning, I don't have enough credit. I have been late. I have school loans. If I want to get a mortgage, what is the top 3 things that can impact me getting a loan for a home the most?
Good question. Credit.
Okay.
I mean,
not having enough credit. Having bad credit.
Delinquent credit.
Delinquent credit.
So paying your bills on time.
I mean, just basic
matters.
Yeah, man.
And I think people don't realize that as they get ready to purchase a home, all the stuff they've done prior, like, I'll pay it when I feel like it, or I'll pay it when that stuff impacts.
Or if I'm 5 days late, does that make a difference?
Late is late, Key.
Late is late. Oh, no.
Late is late.
Saying, if I'm 2 days late versus 15 days late.
30 days late is what gets reported.
Okay, 30 days late.
30 days late. Okay. Yeah, 30 days
30
late.
days late.
That's what gets reported.
Y'all heard it. Just don't be late. I'm
just
not even going to say
late. I mean,
even if you're paying the minimum, pay the minimum.
Yes, pay the minimum on time. That is so important.
Okay.
I get people who, they woke up and they decided they wanted to buy a house today, but they haven't been paying anybody. And I just, hey, I don't really know what to tell you. I always tell this story when I did we did a financial education course in an elementary school that my sister-in-law is a teacher. And the first thing I asked the kids was, what did they know about buying a house? You got to pay your bills on time, baby.
The kids said that?
Yes. Basic. I mean, come on.
The kids say, pay your parents. Mama, daddy, pay your bills on time. Pay your bills. And you're right, though.
And if you don't, you don't expect there not to be a repercussion for that, right?
Yeah. And unfortunately, we've had clients, and I was that person years ago right? But when you know better, that's the name of this podcast. When you know better, you do better.
You do better.
Right? So that's why we're talking. So glad you were able to clarify that. Pay your bills, man.
Pay your bills. But let me just say one more thing on that. The question is, student loans are a large part of it. I mean,
is that a negative? It's
not a negative on being able to affect. It's not affecting your credit, but it's just your debt to income ratio, because we do still have to count.
Yes,
you have to count that
percentage of it.
So if I owe $30,000 in student loans, that gets incorporated into my DTI.
For FHA, we have to take 0.5% of whatever your student loan balance is. So if it's if it's $100,000, then we're $500 a month, right? So it can impact certain.
It does
part
matter.
Of
your debt that you have to pay off.
And can I speak on something? This is going to be for the.
Please.
This is for your podcast. This is something that we're going to start talking about. These Affirm payments. You know what Affirm is?
Please explain.
No.
That pay as you go, like when you buy something.
Oh yes, like I think on
like
Amazon.
A layaway.
Yeah, like on Amazon, if you get ready to purchase something, it'll tell you, you can pay in 3 easy payments, or you can delay the payment or something like that. Is that what you're talking about?
That is correct. Okay. That's it. That is becoming a huge issue in the mortgage.
So why is that an issue?
Because it's not on your credit report, because it's not a traditional creditor like a credit card company, but we see it on your bank statement. You're making a firm payment. So if you have these just delayed payment plans, and you have them say that, it's going to take you 10 payments or 12 payments, we have to count that against you, just like a debt. And it's a new issue.
Did y'all know that?
It's a new issue. Yeah.
It's a new issue that's popping up because people are taking advantage of that.
Everybody's doing. You can do it on where it's an airline ticket. You can do it on.
You can do it on.
It's on everything.
Wait.
You sure can.
Anything.
Are you saying
I've seen that.
If I opt to do the Affirm payment, the delayed payment, the
3 easy payments,
the 3 easy payments, so are you saying that lenders look at that as a negative, or it's just incorporated?
It's a part of your debt.
It's a part of your
debt that we didn't anticipate initially when I saw your credit report, because it's not on your credit report.
So if I buy them, just for this example here, if I buy something that's $1,000 and I decide to pay that over 4 payments, it's $250 every quarter, if you will. So you're seeing that's going to be like,
is that considered like revolving credit, sort of, so to speak?
It's not. It's more like installment.
Installments.
Okay.
So you incorporate that. Say you owe because you're making these payments.
Yeah. So the biggest thing is how long do you delay the pay? How long do you extend the payment? For us as lenders, once it gets over 6 or more, then we have to start counting it. And I'm saying this because people don't know that. And it's so common. It's so common. It's becoming a problem that has not gotten out there for the consumers to realize it's a problem.
Gotcha.
Wow.
Yeah.
Because I've been like tempted to click that button.
Don't click that button.
I've been tempted to click it.
That button.
I'm going to do 3 easy payments.
Because it's convenient. And
it is convenient.
Why not?
But not knowing how that's
option, why not?
impacting your credit or your options.
You're paying interest on it. It's not free. It's not.
Nothing is free, y'all.
Nothing is free.
Man, Micole, you're dropping some jewels.
Yes.
This is stuff that we did not know that can impact your ability to purchase not just a home, but to purchase other assets. Right?
It's a new thing. Wow.
Any lasting words that you want to leave us with, or nuggets?
I know one was pay your bills. Pay your bills on time.
Yeah, pay your bills on time. and never be scared to see where you are. You know what I mean?
That's a really great one.
Because you have to start somewhere. So I always tell people, you get people who scared. I'm scared of my credit. I'm scared. Definitely pay your bills on time. But if you know you haven't, or you have, and you still just want to know that where you stand to buy a house, come on, give it a try. You never know, because that's how you plan for the future. If you're not ready now, we always say it doesn't have to be
It's okay.
It's okay. It may not be
okay.
right
today.
Yeah.
It's okay. It's not right now, but we're planning.
That's right.
Right. You at least have to start somewhere.
You do.
You got to start somewhere. And that's what I love about what you do, Micole, is if, when we send someone to you and just to say, hey, just see where you are. Because what Micole will do is guide you to these are the things you need to do. You may not be ready right now, but these are the things that you do need to do to be ready in 6 months or ready in a year or whatever the case may be.
Whatever it is.
Know your status. Know your financial status.
Yes,
and it makes a big difference on how you move.
It does.
Right? It's like, okay, I know where I'm at. Yes, I may not be ready right now, but I understand, okay, this is where I'm at. This is what I need to do.
Ready.
And 6 months, a year from now, I can adjust accordingly.
Yes.
Wow.
Yes.
Micole, I gotta give you a high five.
Sassy is who she is to me.
Listen. Micole is family.
My term of endearment.
Have y'all learned something today?
You have.
Yo, we got one of the most experienced
we love her so much.
mortgage lenders in the building.
Yes.
Listen, Micole, how can they find you? Are you the mortgage lady? I saw that on IG. You gotta change your name on me. I said, Micole now. But listen, it says what you do.
Mortgage lady.
Listen, she's on IG as Micole, the mortgage lady.
That's right.
But she's so much more.
And to mention, you and your husband are in business together.
Yes, we are.
Right?
Yes.
Quickly, before we leave, my guy Tim Sudduth.
Yes.
My guy.
They are partners.
So as Key and I are partners, the way we love the Sudduth team.
That's right.
Is because my guy Tim and Micole are amazing mortgage lenders here.
That's right. They
in
are.
the Metro
They do a
Atlanta
great job together,
area.
you guys.
Yes.
Thank you for joining us, Sassy.
Thank you for having me.
/Micole. We love you so much. Thank you for bringing so many nuggets and helping people understand. Hope you guys enjoyed this segment of The More You Know, because when you know better, you do better, guys. When you know better, you do better.
That's the goal.
Make sure you like, subscribe, share.
Smash
Send
that
this
button.
to your friends. You got to know what you need to do to qualify for a mortgage. We love you guys. Peace. Until next time.
Key and Will, baby. Let's go.
Bye.
Peace.